Welcome back, traders. In today's video, we're diving deep into one of the most powerful concepts in smart money trading, propulsion blocks. But quick heads up, if you haven't watched my breakdown on order blocks, hit pause and check that out first. This video builds on those concepts, and without that foundation, some parts might go over your head. That said, I'll start with a brief refresher on order blocks just to get you up to speed. Then we'll move straight into propulsion blocks, what they are, how they form, and most importantly, how to trade them like a pro. Let's jump right in. Order blocks are typically two-candle or multi-candle patterns that reflect decision-making by institutional players, like banks or large financial institutions. They often appear at key turning points in the market, signaling potential reversals. Let's start with the classic two-candle bullish order block, usually seen during uptrends. Here's how it plays out. In the middle of a bullish trend, price suddenly prints a strong bearish candle. This move is designed to trap sellers, trigger stop losses, and gather liquidity. Immediately after, a large bullish candle follows and closes above the open of the bearish candle. That close is key. Once that happens, we expect price to come back and retest the open of the bearish candle, giving us a clean long entry. While others are exiting their trades in fear, we're stepping in, right before the next big move begins. This same logic applies to multi-candle setups. For example, you might see 3 consecutive bearish candles followed by 2 strong bullish candles. If the final bullish candle closes above the open of the first bearish candle, we have another valid bullish order block. Once again, we expect a retest of that first open before the trend continues upward. Just like with fair value gaps, the 50% level of the order block is critical. We measure the full height of the order block, whether it's a single or multi-candle block, and mark its midpoint. When price retests, it must not close below that midpoint. A wick below is fine. That's just noise. But a close below the 50% invalidates the setup, or at least lowers its success probability. This rule helps with stop loss placement too. You can set your stop just below the 50% level for a tighter setup, or below the swing low for more safety. Personally, I prefer placing it below the entire candle. But tighter stops do improve your risk to reward if you're comfortable with the risk. Now, let's move on to the main topic, propulsion blocks. So what exactly are they? In general, propulsion means to push forward. In trading, a propulsion block refers to a candle that drives price away from itself, with force. A propulsion block is a new order block that forms within the zone of a previous order block, and then causes a strong continuation in price. When price returns to this propulsion block, it often reacts sharply, creating a tradable opportunity. Let's break it down step by step. A bullish order block forms, and price closes strongly above its open. We wait for price to come back and retest the 50% level of this original order block. During the retest, a candle of the opposite color forms. This marks the beginning of a new order block. If the next candle closes above the open of that new block, congratulations, we now have a propulsion block. We expect the 50% of this propulsion block to hold, and that's our trade setup. At this point, you can enter on the close or wait for a retest of the propulsion block. In both cases, the stop loss goes just below the propulsion block candle. The same structure works in bearish scenarios, just flip the candles. Let's say we have a series of bullish candles, followed by a strong bearish close. That bearish candle becomes our key level. If price retests the 50% and forms a new bearish order block, we wait for a close below its open. That gives us a valid bearish propulsion block. We expect the 50% of this new bearish block to hold, and we place our stop above the propulsion zone. Important tip, if price retests the original zone but closes beyond the 50% level, and then a new candle breaks structure again, that zone loses credibility. In most cases, you should avoid trading those setups. However, and this is just my personal approach, I still consider those valid as long as a new order block forms and its own 50% is respected. Let's walk through a full example. We're in a bullish trend. The first candle that goes against the trend is marked. That's our potential OB zone. Once a bullish candle closes above that open, we confirm the order block. Now we wait for the retest. And when it happens, we watch for an opposite color candle to form a new order block. That new order block becomes our propulsion block after a close above its open. Now we just need 50% of this propulsion block to hold. I enter on the close, place my stop just below the zone, and boom, we hit TP2 with ease. Simple and effective. Again, we're in a clear uptrend. Price pulls back, but this time it doesn't close above the OB initially. So where's our new OB? It's that first bearish candle after a bullish push. We wait for a bullish close above it, and that gives us our next order block. Still no retest? No problem. Price enters a fair value gap, a good sign for continuation. Once price closes above the block again, it becomes our new propulsion block. At this point, we no longer care about the previous 50%. What matters is the new 50%, and we place our stop accordingly. This is another clean, high-probability setup with great risk to reward. All right, traders, now it's your turn. Post 5 examples of order blocks and 5 examples of propulsion blocks in our Telegram group. I'll review them and give you direct feedback. Also, don't forget to leave a comment below and let me know what you think of this lesson. Your feedback helps me improve future content. Thanks for watching. And as always, trade smart, stay patient, and I'll see you in the next session. Take care.